Today, folks, oh, what a perplexing way to start a week. Amazon Web Services took down a dozen trading platforms, including Wealthsimple, Robinhood. Heck, logging into my MacBook, taking a look at my watch list, lagging 9 ways to hell. StockTwits was virtually not loading for me this morning. And in spite of all of this, on this a very auspicious day, markets, baby, global market ETFs, all-time highs. S&P 500 touching all-time highs. Your favorite tech stocks, guys, propelling my portfolio damn near all-time highs. I can't wait till this spreadsheet updates into the close of the market today. But on this day, I thought it would be appropriate to answer your Delulu questions. As a finfluencer clown, somehow with no financial experience, I mean, I've got no degree in this space, and yet I feel more grounded than so many investors out there, especially when you're leaving comments and questions on TFSAs and RRSP videos I'm making that are a detriment not only to yourself, but the broader investing community. So in my pure arrogance of this channel and my hyperbolism, that's a real world, I think it's appropriate to answer some of these comments and questions. So if you enjoy this finfluencer clown in the sea of many, consider hitting that subscribe button. Join me on your financial journey, guys, and let's do this together with question numero uno and the dividend investors that I think are some of the biggest clowns driving newer investors to detriment their long-term performance. The benefit of dividend stocks is you always get a payout. With the S&P 500 and tech stocks, if you get hit with a lost decade, guess what? Most people will sell at a loss. And I'm here to tell you guys, if the markets tank precipitously, even the S&P 500 in like the 2008 financial crisis, most dividend stocks went way lower than the broader indices did. I mean, you look at mega cap companies like Canadian Natural Resources, the banks dropped anywhere from 50, 70, some in cases even 80%. And in your mind, collecting that 3% yield, though psychologically might keep you in that stock, it's still not probably the most appropriate allocation, because you have to take into consideration, guys, your risk tolerance, your time horizon. If you're closer to retirement, I get skewing toward dividends because typically dividend stocks like SCHD have less volatility to them, but you have to recognize no one's telling you that, hey, we might be in a lost decade for SCHD right now. It hasn't done anything for 5 years here, guys. More mature companies don't have the same growth rates. And when you start thinking about yield, you stop asking yourself, where is the most appropriate way to allocate my capital to the best possible companies in the world to get the best rate of return? Because guess what? Total return at the end of the day is your actual return, whether you decide to hit the sell button or just collect the dividend yield here, guys. And if you can't handle the risk, you might need to allocate toward treasuries, bonds, maybe a little bit more of that. But regardless, guys, don't get caught in this crazy dividend trap. It's a horrible way of thinking about investing. And I mean, look at my example here. I sold out of SCHD, had 100 grand sitting in it back in the Terra 4 of April 28th. I'll always remember this day because I sold off 100K of SCHD and I put it all into the S&P 500. And guess what? My VOO position is up almost 23%. SCHD since then is up 4.5%. The markets now have to drop by 15% to go back to where SCHD is today. And God knows that the S&P tanks, a lot of those stocks sit within SCHD, and it's likely SCHD will go down with the market. It's probably not as hard, but still going to go down a lot, guys. So you just, even in retirement, look at the entire markets and figure out how you have to allocate that capital toward growth and income, guys. And again, just global markets, because if you can't do that yourself in a very healthy and in pragmatic manner, you should be handing your capital off to a financial advisor and perhaps not listen to the influencer clowns, the covered call investors, the dividend investors that can't look at another perspective and think that this is the way. It's not. It's a horrible, detrimented way to investing. And I get it. There's nothing wrong with SCHD. My parents hold it in their retirement. I would recommend it as a great ETF for the right kind of investor as part of a portfolio. Now, when do you consider yourself not young when it comes to investing? I have a similar TFSA value, and as you at this time with, about 40 grand left of room, trying to decide if I take 100K out in December, pay down debts, and then have that contribution room reset. Firstly, time horizon. If you've got 20 or 30 years to invest, that's a long time horizon. I mean, no one's ever lost money in the S&P 500 over a 20-year period. And on top of that, and it's a crazy fact, isn't it, that the markets have always gone up over 20 years, even through all those cyclical like dot-com bubbles and '08 financial crises. But regardless, I can't tell you if this is an appropriate decision for you. I took money out of my TFSA to purchase a piece of real estate 2 years ago, and that's because I was young. I'm only 33, guys, and I knew within a few years with my income, my hard work, I could build that account back very aggressively and very quickly, so I would still have plenty of years ahead of me to capitalize on growth. If you're in a similar situation, it might be appropriate. Maybe your TFSA won't return as much as the debt that you have. So yeah, maybe paying down the debt's a better idea, but that's up to you. Stocks in a TFSA are a terrible idea, especially speculative ones. Basically, it's easy to get yourself into the red and you can't write off the loss. Also, once you lose that room, you never get it back. Stick to the diversified all-in-one ETFs and funds. Stock picking in a TFSA is just a bad advice overall. That account is single most important beneficial registered account Canada's have, and you'll realize this once you start retirement planning. And yes, you're absolutely not wrong here. I think the tax-free income in perpetuity for the rest of your life, you don't want to lose that, but the reality still stands that if you don't want to manage an account, buying an all-in-one ETF is probably the best way most people should be investing. But I would be a hypocrite to sit here and tell you I don't think it's more, that I think personally it's more appropriate for a younger person to be skewed more toward growth in the TFSA, because regardless if you invest in a TFSA or not, if you're buying Canadian dividend stocks or even capital gains are highly tax efficient in a regular brokerage account. Like if you make $50,000 of qualified dividends in a regular brokerage account and you have no other income, you will pay zero tax on it. That's why I think younger people should skew more toward growth in a TFSA, especially if you have a long time horizon ahead of you. But regardless, I'd be a hypocrite to tell you not to buy individual stocks either. I built my TFSA and my fiance, we still hold individual stocks in these accounts, but in a healthy way that if say Meta or Google went to zero, we're not losing all our tax advantage room. Like it's a percentage of our portfolio. Like we're not making our accounts to be able to go to zero, because that would also be very foolish. But I can't sit here and tell you what to do, because if somebody told me not to buy individual stocks in my TFSA wouldn't be over $200,000 today, guys. That might not work for you though, so I can't recommend and tell you what to do. But that was a very good comment. And this one, oh my God, this is hilarious. You know it's going to start great when it says Pee Wee Herman's ideas to pick stocks. It's not my idea. It's probably why most people join this channel. If you see today, my TFSA is mostly VDY and VOO. But regardless, let's go back to that question there. This is the highest risk investing strategy there is. I beg to differ. I think if you're buying penny stocks, maybe, but a lot of people do options trading. They lever into their TFSAs. I think there's more risk to levering into individual stocks or levering up stocks than there is owning an individual stock. But this video should read how to win the lottery. Guys, I don't know anyone in their entire life that has ever won the lottery. Personally, nobody. But you know what I have done very successfully is I've picked some individual stocks, weighted them correctly in my portfolio, and though I've had some losers, the winners definitely outgained the losers, and I've done that very successfully over a decade. I don't know anyone that has successfully won the lottery 10 years in a row, but my accounts have definitely done very well over a decade, right? Regardless, basically, him and his wife have no kids, very easy to save money with 2 incomes and controlling your spending. This channel is a sinking ship of advice. So showing you a 33-year-old's portfolio that I think is well balanced for my age, while also focusing on my financial independence before having kids, where my wife wants her own independence and she wants to work. Will we be frugal is terrible advice. It's sinking ship advice, guys. Avoid this channel at all costs. Any clear established rules surrounding TFSA rebalance to avoid being subject to a CRA audit? Do we need to hold stocks, ETFs for at least a year, or is reallocating every quarter an acceptable frequency? So when it comes to rebalancing, I don't think the CRA is going to bother you about your TFSA so long as you're not day trading. They only really care if you're doing like active options trading that are short-term focused and day trading, guys. I've rebalanced over a few months. My typical hold is 1 to 3 years, but if market conditions change, I mean, if fundamentals change on a company and your opinion changes, I don't think there's anything wrong with trading in and out of it over a few month period. The CRA has never bothered me about it, so I'm sure you're going to be just fine regardless. But just keep that in mind. Just don't do day trading and you'll be perfectly fine. What are your next plays? I mean, have you been waiting since, or I have been waiting since Google Take-Two is climbing. I suspect pre-order releases in November or December, $300 plus. Yeah, Take-Two, I mean, the gaming industry is crushed. I think Take-Two is more of a momentum play. Fundamentals aren't crazy, but Roblox is absolutely crushed it as well. When it comes to Google and Meta, guys, I have a hard time finding better companies than that right now, but I am thinking about starting for my channel what I'm calling the recovery play account. There's a lot of dividend stocks I personally like TELUS that I think could offer outsized returns in its recovery. Hershey, Nestle are stocks I'm looking at. These are stocks that I've mentioned when I want to build out other accounts and currency accounts. I'd like to start out like a Euro account where I own some like European stocks and actually collect Euros. I think would be really cool. And I think that could fall in line with stocks like Nestle as an example. But I think it'd be fun to look at some of these recovery stocks because cocoa prices are correcting and Hershey's a big chocolate company that got crushed on the cocoa inflation period, but now cocoa prices have come down a bit. So I've looked at those stocks, but I told you, like, for me to make those material positions in my portfolio, they just wouldn't be big enough to make a major impact because there's still no better stock out there for me than Google and Meta. But I still think it would be great to build out that for this channel. I think it'd be fun to watch those companies and just maybe even put 10 or 20 grand between 3 or 4 stocks to see how they do. But on your path to financial independence in this auspicious moment, I'll pass that question off to you guys. I'd love to know what you think about all of this in my comment section below.